happy to be with all of you today. Oh, thanks for joining me. Quick side note before I get talking about today's subject, which is startup expenses. There's a really wonderful benefit the IRS gives to you when you're first starting your business, and I want to talk to you about it today. But first, I want a quick mention. If you've never heard me mention this before, I think it's not a mystery to any of us that social media is not good for your mental health. And I've really looked into that a fair amount. But I really noticed it this weekend because I had a post, like I basically try to stay off Instagram as much as I can. I eliminated my personal account altogether, and so I only have it for business. And listen, if you're running a business, it is the modern day like newspaper ad, radio ad, like all of those things, I I don't fault any business who uses Instagram or Facebook as a signpost in their business. I certainly do that. And I don't really see, it really kind of is what's available. And so anyway, I use it for my business, but I try to stay off it basically as much as I humanly can. And I create limits around it, pretty strict limits around it for myself, just because I've noticed it's so bad for my mental health and it's so distracting. And when you're running a small business, as you know, there's just so much work to get done that distraction is really an enemy of your business doing well. I mean, it really is, like, not to put too fine a point on it, but things that distract me are things I need to get rid of. So, um, anyway, I also want to tell you that I read this truly amazing book. I'm now going to blank on the name of it. Oh, it's called Stolen Focus, by, I believe it's Johan Hari. I'll link to it in the show notes because it's so good. But he talks about these studies about what the algorithm actually surfaces, and it surfaces controversy on purpose, right? Rage, anger, upset. And if you think about that, like as a human being, how absolutely awful that we're like being manipulated by this machinery that is like making us angry, like surfacing things that are negative on purpose. And Johan Hari in that book like talks about keywords that will boost your post more easily because the algorithm is selecting for them. And they're so horrifying. They're like outrageous, angry, shame, things like that, words like that. Anyway, check out his book, Stolen Focus. It's amazing. It might change how you operate your business. It definitely did for me. But what I was noticing, the point of my rambly story is that I had a post. I'm not aiming for my post to go viral in general. I mean, great if they do, but I don't want to play the game of the algorithm because I find the algorithm really manipulative in a way that is destructive for our society, right? So I'm not looking to gin up controversy. It's the last thing I want in this world. But I did have a post that went semi-viral, I would say, last week because I created a free tiny little mini course on how to file your BOI report if you have an LLC. P.S. I'll link to that in the show notes. If you have an LLC and you haven't done this new reporting, check out my episode on that 2 episodes ago. It's for the Corporate Transparency Act, which is an awesome law. I'm a big supporter. But I made a free course, and this post I made about this free course went semi-viral, which makes sense, right? I'm giving away something really valuable and people are sharing it. And that's great. That's what I want. I want everybody to know about this law and comply. But I just noticed how even the fact of the slot machine effect of having a post go viral, it's just like winning a jackpot in a casino. I mean, and people who design these algorithms actually have studied that. Like, this is deliberate. This is not an accident. And so here I am, and it sucked me back into Instagram. I found myself kind of obsessing and wanting to check. Oh, did it do even better? Oh, how did it do in the last hour? Right? Like, check back in. And I realized I was like 2 hours into this, and I was like, oh my God, they did it to me. They pulled me back in. It made me so mad. Like, I have felt so on top of my Instagram behavior, and it got me. It got me. And I was like, damn it. So anyway, it's just, it's random rewards like a jackpot. the casino of Instagram in your mind. I was like, okay, this is right. This is that manipulation that I hate, and I don't like playing this game. Anyway, do file your BOI report. I do recommend you do that. You don't need to get on Instagram to do it. The whole reason I started this podcast is really because I wanted to have a place that is off of Instagram where I really can connect with you, right? And I can do things algorithm free that are where I can give you a lot of value and education. And I can also do it in more than like a 60-second reel, which seems like it's not an appropriate format for a more thoughtful conversation or more in-depth education. And so to me, the podcast, this is where I put my focus on purpose. And I think the podcast, I like it better. You, I hope, like it better. Feel free to tell me. But I love it for that reason. Anyway, the algorithm, yuck. So the funny thing is that podcasts, they're good and bad. I'm myself a lover of podcasts, but the hard thing about a podcast is they don't go viral. It's actually very difficult to get someone to share your podcast. So it's actually incredibly difficult to grow a podcast. So P.S. If you like my podcast, if you're ever listening to an episode and you're like, oh, that was helpful, it would be the most wonderful thing in the world to me if you would share it with a friend. If you have a friend who could use the information, anytime you share it, you are really doing something wonderful to me. And you're also helping us all stay off Instagram. So thank you. Thank you if you find that helpful. All right. So speaking of, let's get into today's topic. I want to talk to you about startup expenses. So last week I was talking to you about losses in your business. Losses are normal, especially in what's called the startup phase. In other words, all businesses start in the negative, right? It's normal because you have to spend money to create the business before the business can exist, and the business has to exist before the business can make money, right? So the order of operations is always going to be negative income, aka loss, before there's a profit, right? The break-even point signifies that magical moment where you tip from loss into profit. And that's a beautiful thing. But I'm here to normalize the fact that as a business, you're going to have some years that are negative. You're going to have some years that are losses. And the startup phase is the most common, most typical time to have a loss. And so, given that I spent a longer episode last week really digging into the issues around losses and how to defend a business loss and make sure that it is not misclassified as a hobby, I thought, oh, well, let's give the positive side of that this week, right? Let's talk about one of the major benefits that you get as a business when you're starting out, which is this special category of expenses, of deductions called startup expenses. Okay. So this episode is for anyone starting a business, any kind of business whatsoever, whether it's in the arts, whether it is a visionary, mission-based business, anything at all. This applies to all businesses. So I just wanted to give you the rules for startup expenses and give you a couple tips for how to handle them. All right. So startup expenses that are expenses that are incurred before the date that your business starts. Okay. Now, these can be things like an analysis or like a market research, a market survey, like to test the viability of your business idea, right? You could hire a marketing company. I know there's some companies in the town where I live that will do like market research for you. They'll send out surveys. This is a wise way to start a business, and the expenses of doing that count as startup costs. Other things that count as startup costs are advertising for the opening of your business. And of course, the advertising can begin before the business doors open per se. Like these are not necessarily completely aligned. If you have a physical space or you have a launch date, let's say you're starting a gym, and the gym opens on June 1st. Well, you're going to start your advertising campaign before June 1st because you need people to show up. You need the advertising to be going well before that, right? So your official start date might be June 1st, but your advertising will actually start a little before. Also, salaries and wages for employees who are being trained and their instructors. So if you have to hire people and train them and pay the trainers, that all counts as startup expenses. Also, travel and the costs of securing like distributors, suppliers, or customers, that is also deductible, right? So this could be even attending a conference, right? To make a bunch of contacts to really kind of get word of mouth going about the fact that you're starting a new business. This is a pretty frequent use of going to a conference for most businesses because you really have to get the word out at the beginning, right? And also salaries and fees. I'm actually reading off the website of the IRS here. So these are all like from the mothership. Salaries and fees for executives and consultants or for similar professional services. So just for an example, if you consult with a lawyer or an accountant to talk about business structure, tax entity status, maybe forming an LLC, something like that. I want to be very clear. These things are not necessary as you start a business, okay? But you can have them. They might be nice. They might be a positive thing. So if you meet with a lawyer or an accountant, if you meet with an insurance broker, any fees that you're paying there are going to get to be lumped into this category called startup expenses. Okay. And just so you know startup expenses have to meet two requirements. One, it has to be basically an expense that would be deductible anyway during the course of your business if your business had started already. But that it's a cost that starts before the business itself starts, right? That's the reason that there's this special category, because you're going to do the market research, you're going to do the networking, you're going to do the meeting with business people, advisors like accountants and lawyers. You're going to do that before the business opens. And so we need a way to capture expenses that actually happened before the date that your business started. So it's a way to pull expenses from a different tax year onto this year's tax return and take them as a deduction. This is not something you get to do ongoing during your business. From then on, once the start date happens, now expenses that go in your taxes as deductions have to be incurred in that year. So startup expenses is a special category where you're taking expenses for things that happen before that year. So it's pretty cool. Now, the structure of startup expenses is interesting and tiered. For most of you, the relevant part is that your first $5,000 of startup expenses are deductible off the bat. Okay. And it can be a little confusing because there's not a special category listed on your tax return. So if you don't know about the category startup expenses, it's easy to miss it. So startup expenses go on, you actually list them on other expenses. So the last line of your deductions on the Schedule C is this catch-all category called other expenses. And you actually, on the other expenses line, you actually write the phrase for what the thing is. So that's where you would put startup expenses. And you can list up to $5,000 there for that. Okay. Now, of course, there are businesses out there who will spend well over $5,000 on startup expenses. This is all going to depend on your your amount of funding to begin with, also on the expected scale of your business. So you're allowed to take the first $5,000 as a current year deduction. If you have more expenses than that, you have to amortize the rest of your startup expenses. So they will still go in that category called startup expenses, but you will break them up as a depreciable, as a capital expense, and you will depreciate them over a 15-year period. Okay. So that's how startup expenses will work if you spend over $5,000, up to $50,000. Okay. most of you out there are not spending over, if you're listening to this podcast, the chances are good you're not spending over $50,000 on startup expenses, because that's not really my audience. But there is a little bit of an additional rule if you spend over $50,000. I'm not even going to get into it here. But what's interesting to know is that there's a mechanism, and there's these things that feel a little bit complex, like up to a certain dollar, you get to do this. And then over this dollar amount, you do this. And then over that, you do this other thing. I want you to know that when you see a thing like that in the tax code, it can feel like complexity. I mean, it is legitimately, it is complexity, but it's actually there to create fairness, and to create a bigger benefit for a lower income taxpayer. In other words, like the very best of the startup expense rules go to people spending less than $5,000. And then a pretty good deal, a very good deal, is going to somebody spending up to $50,000. And then a little bit more tricky, but perfectly lovely rule is for people who spend over $50,000 on startup expenses. So this tiering that you see from time to time within the tax code is actually there to kind of give immediate benefit to lower income people and more long-term benefit to people who have more money. And it creates equity in the tax code. So I just want to kind of point out why sometimes there is complexity and why it's actually necessary. So sometimes I was talking about tax fairness with a friend on the phone the other week, and she was like, would it be fair? I hate how complex taxes are. Shouldn't we just do like a flat tax? And I was like, no, no, no. Because a flat tax is something that is very regressive. A flat tax is something that will hit lower income people the hardest and higher income people the least. And so there are real reasons for some of the complexity we have in the tax code that are good, that I wouldn't remove. Now, grant you, are some things overly complex? Sure. Sure, that may be true. Okay. So to summarize, startup expenses are an awesome deduction that you get in your first year of business. So if it is your first year of having a Schedule C, there is a checkbox. I believe it is line H, the letter H, like Hannah, on your Schedule C, right at the top, right within the first third of the first page, there is a line called line H, and it says, if you started or acquired your business this year, check here. So you need to check that box. That box basically unlocks your ability, your privilege to take startup expenses. So something very important, and I say this to all you people who are in school right now, who are going to have your first Schedule C in the next year, I want you to know this is here for you. Okay. This is here especially for those of you who are in school, who are about to start a business, or if you don't have to be in school to be about to start a business. But if you're about to, if this is on your radar, I want you to note that you do have a checkbox that you have to check on the Schedule C, that this is your first year. And that's a really, it entitles you to an extra benefit. So it's awesome. You want to do it. Okay. So startup expenses are for expenses that you incur before the start date of your business, and they allow you to take those expenses from prior years and put them on a current year tax return for a tax benefit now. This is really awesome. It's a huge benefit for you and your business. Often a business is going to have a loss in the first year because the first year for pretty much everybody is the startup phase. The startup phase is a really important phase to know about, and it's important to know about the norms in your industry because it is okay, basically, to have a loss during the startup phase of your business. All right. I want you to understand that this is not because you're broken. This is because this is the normal order of operations. It takes some time to build a profitable business, and that's okay. All right. And if you're worrying about what happens because of your losses, what position they put you in, or how you might need to document proof or evidence that you have a real business intent and you're not just running a hobby, listen to last week's episode. I'll link it in the show notes because I talk all about that exact issue, which is determined by a rule called the IRS's 9-point test to determine activities engaged in for profit. All right. So I hope this episode on startup expenses has been super useful for you. For those of you thinking about starting a business, I'm rooting for you. I love it. P.S. If you join my program, Money Bootcamp, which helps you start, set up the taxes, set up the retirement accounts, even set up some of the legal pieces of your new business, that would, of course, count as a startup expense. And it could go on your other expenses line on the first year you deduct expenses. So just letting you know that that's true. But I hope this has been helpful for all of you. And if you have a friend who is in their first year of business, or who you think this episode could help, please share it. I will be so, so grateful. That really helps me grow this podcast, which is hard to grow outside the algorithm. All right. I will see you on the next one, everybody. Thanks so much for listening. Bye. Thank you for watching. If you like this video, be sure to like, leave a comment, and subscribe to my channel. I'm so grateful for that. This video is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links I reference at sunlighttax.com/podcast.